Hi everyone. This is my little lecture on job order costing, okay, to align with our module 4. So I just wanted to walk through a comprehensive example with you guys so that the concepts would make a little more sense. Hopefully you've watched the additional 2 links that I posted for you and you followed along on the links that we asked you to review in order to complete your pre-assignment. But we're gonna, go through this now in depth, and we'll take it from there. So, last week we talked about determining of costs, okay, raw materials, direct labor, indirect materials, etc., trying to determine if they're product costs or period costs, what are prime costs, what are conversion costs. So we did a lot of the defining part of cost accounting. So now we're going to look at how to properly cost jobs, okay? You can either, depending on the type of work that you're completing, process costing might make some more sense, or job costing might make more sense. So we're going to focus on job costing because it can be a little bit trickier, and you probably gathered that when you looked at some of the questions that we've asked you to do in the assignment and some of the examples that we've pointed you towards. The real trouble comes from the fact that when you have manufacturing facilities and you have all these overhead costs, right? Depreciation, utilities, insurance, the indirect labor components, etc. It's really hard to figure out how much of those costs you apply to your what it is that you're producing or creating. So that's really what the goal of this module is to figure out how we go about and apply those overhead costs to the jobs to get a true and accurate picture of what it really costs us to perform a function, okay, to perform a certain service or a certain type of product, etc. So that's the goal here. So I mean, what you have to keep in mind is, when something is direct, like we talked about, direct material and direct labor, it's very easy to say, in order to complete job XYZ, we use such and such material, such and such labor, because they were direct. They're very easily traceable and trackable to the job. But the trouble stems from when it's indirect, all the manufacturing overhead costs. How do you account for that within your job? The solution is not to not account for it, because you have to. There is that element of the overhead that you have to apply to a job. So we do that by what's called using a predetermined overhead rate. So before you'll start your particular job, you'll have your budgets. Okay, you'll create a budget of what you estimate the job is going to cost you, and what your input hours are going to be like, whether it's direct labor hours, so man hours, or whether it's machine hours. You'll have hopefully a good sense of what it's going to take you. So very simply, you'll just take your estimated budgeted overhead cost divided by your estimated base, which is, like I said, could be machine hours or direct labor hours, to get a predetermined overhead rate. And then you'll say, we did X amount of hours or machine hours, apply to that the rate that we estimated, and that's what we think where we'll end up in terms of our total manufacturing overhead. And then at the end of it all, you'll do a reconciliation to see when the actual numbers come in for your overhead against what you estimated, if you're over or under, and then you'll fix that typically through your cost of goods sold. So we're going to walk through this example which explains that whole concept for you guys, okay? So here we have the Fine Manufacturing Company, okay? So they use the job order costing system, and the company uses machine hours to apply overhead cost to job. So this is your first key piece of information right here, okay? For every problem that you'll get, you need to make sure that it's identified for you and you understand what the basis is for applying overhead cost. Next, they tell us that at the beginning of 2012, that the company estimated that 150,000 machine hours would be worked and 900,000 overhead cost would be incurred during 2012. So this is what we need in order to determine our predetermined overhead rate. Okay, second piece of critical information if you're going to complete a job order costing. Okay, or you're going to use job order costing. So now to reiterate what we talked about in class the first couple of weeks and probably last week as well. In a manufacturing environment, you don't have that one-line account on the balance sheet like you do in retail or merchandising for inventory. Okay, you're going to have it broken out by the various stages of production. So remember, the first stage, raw materials. We bought the raw materials. They're waiting to be put into production. Second stage, work in process. We've moved them from raw materials and we've put them into production. Third stage, finished goods. We had them in production and we moved them to finished goods, and then in order to remove them as an asset. So when we remove them from the balance sheet, that occurs when there's a sale, and we transfer that cost then to the cost of goods sold. Okay, so that is the flow that you have to understand. We start at raw materials, and then we move to work in process, and then from work in process we move to finished goods, and at the point of sale then we transfer out of finished goods to cost of goods sold. Okay, so this is imperative that you understand this flow of inventory, and that $1 of raw materials will never be also work in process or finished goods or cost of goods sold. Okay, you'll only have accounted for an item one time in one of these inventoriable buckets. Okay, so in this example, they're manufacturing. There's a slew of events that have occurred that we need to dissect in order to figure out if we've accounted for all of our costs properly. And that's the goal here for this particular job. Have we accounted for all of our goals, all of our costs? Are we using the right estimates? That's really, one of the questions that we're trying to answer here. When we came to this conclusion up here that, it was going to take us 150,000 hours and $900,000, were we in line with what was really happening? And if you're consistently behind in your estimates, then you know that there's an issue in the methods that you have in place to either account or try to budget for your costs, or you're not really capturing the actual input that is required, or you could be too high, you're counting for too much and you're coming in lower, or you're using less hours than is actually needed. Okay, so first off, the first transaction, raw materials purchased on account, 820,000. So what's in red are my hints or my notes. Okay, and this is going to be posted as well. So if it's not 100% clear as you're looking at it right now, don't worry, because I've also posted it in Slate for you to download and print and have on hand while you listen to me talk here. Okay, so raw materials purchased on account, 820,000. Do not let the word raw materials trick you or throw you off course. Raw materials and inventory, same idea. If we were looking at a merchandising business or retail business, we would have said we bought goods on account for 820,000, and we would debit inventory and credit accounts payable. This is no different, except we debit raw materials, that's our inventory account, and we'll credit accounts payable. The same idea. B, raw materials were requisitioned for use in production. 760,000, broken out as 720,000 direct materials and 40,000 indirect. So what's happening in this transaction is this right here, this movement right here. What they're saying is that we added first 820 to this 40, and then we took out $760,000 of this raw material to put into production. 720 is direct and 40 is indirect. And why the breakout is important is because, remember, we talked about this. Your direct materials can directly be attributed to what it is you're producing. whereas your indirect materials cannot. So 720 goes as a debit to increase your work in process, and 40,000 indirect materials is debited to manufacturing overhead. Okay, indirect costs are not debited or credited to the work in process account. Okay, they're debited to manufacturing overhead. And then C, direct labor, it's the same idea. Okay, so direct labor 150,000, indirect labor 220, sales commission 180, and administrative salaries 400,000. Okay, so we can transfer the 150 to work in process because it's direct. The 220 because it's indirect, not directly attributed, traceable to the product. We get to debit. We're going to debit that to manufacturing overhead. Sales commission is a period cost, not directly a product cost, so it will go to sales commission expense, and administrative salaries will also be a period expense, debit administrative salaries. And then the credit will be salaries and wages payable on the assumption that we haven't paid them yet. Okay? Sales travel costs, straightforward. Sales travel expense, E, or an accounts payable, credit accounts payable. E, utility costs incurred in the factory. If this had said building or an office building, then it has nothing to do with production. Therefore, we would do utility expense, credit account payable. But because we're talking about the factory, it now means that we're dealing with manufacturing overhead. So we will debit manufacturing overhead and credit accounts payable. Advertising expense, broad, not attributable to the product directly. So we're going to debit advertising expense and credit accounts payable. Depreciation will follow the same line of thinking as B and C. 560 is related to the factory, so that will be debited to manufacturing overhead. And 140 is related to the selling and administrative activities. Therefore, the 140 is a period cost that we can debit to depreciation expense immediately, and the credit will go to accumulated depreciation, your standard journal entry. Insurance expense that has expired during the year. So the 20,000 was prepaid and it is now expired. We've used it up for the whole year. 14,000 is related to the factory and 6,000 to selling and admin. Same principle. 14,000 will get debited to manufacturing overhead and 6,000 will get debited to insurance expense for the period. And we're going to credit prepaid insurance because it is no longer a balance on the balance sheet. So what, the whole point of these journal entries here is, because we're not taking these charges, okay, all these expenses that are incurring immediately to an expense account, we house them in the manufacturing overhead account so that we can figure out, once we apply our budget, if we've done a good job in budgeting our overhead. Okay, so we house them in the manufacturing overhead account so that we can prepare a reconciliation to determine how we're doing in terms of being able to budget our costs. Okay, that's what we're doing here, trying to keep them separate from the period costs from the other functions. Okay. Fine Manufacturing Company worked 160,000 machine hours. Manufacturing overhead was applied to production. So if you need more help with this topic, I want you to search applying manufacturing overhead. Tons of information will come up. So to answer I, okay, so we gave you the 150 estimate and $900,000 estimated cost. Okay, let's just run down here. This is how you would apply. Okay, so manufacturing overhead is applied to production by multiplying the actual direct labor or machine hours worked during the year and the predetermined overhead rate that would be computed at the beginning of the year, okay, when we're making our budgets. And it would be shown as follows. So this is the standard formula for predetermined overhead rate, okay, so that won't change. Just your inputs will change. So in this example, it's 900,000 divided by 150,000. So we apply a predetermined overhead rate at the rate of $6 per machine hour, okay? And we're told that what they actually used was 160,000 machine hours. So very simply, we take 160,000 machine hours, multiply it by a $6 rate, and then we have a $960,000 overhead that is applied to production. And the journal entry here will be a credit now. So typically we've been debiting our work in process, okay, for all of our costs. But now we're going to do an actual application. So we credit 960,000, and the debit goes to work in process. So that's how we move all of the costs out, okay? So debit work in process and credit manufacturing overhead. And then J, goods costing 1.8 million were completed during the year. Very simply, okay, don't overread or overlook these transactions. We're transferring from work in process to finished goods. So you'll debit finished goods and you'll credit work in process, okay? We need to increase our finished goods inventory. That's why we debit, and we have to reduce our work in process, and that's why we credit. And then lastly, the goods costing 1.74 million were sold to customers for $3 million. So there's two things that are happening here. The first is we need to transfer this cost from finished goods to our cost of goods sold. So we're going to debit cost of goods sold, and we're going to credit finished goods inventory because we no longer have this 1.74 in inventory. And then obviously the second part is to record the sale. Your standard journal entry is a debit to accounts receivable and a credit to sales. Okay, so it's actually, it's pretty straightforward, but if you're seeing this for the first time, obviously it's new, it's different, and I'm going to give you extra problems to work on, but it's quite straightforward. So here, we have all of the journal entries. I said them, but here they are so that you can see them, okay? Your standard accounts payable purchase. This is your movement of raw materials out of the raw materials account and into work in process, and the indirect charge that goes to manufacturing overhead. Same with salaries. This is directly attributable, 150,000. This is indirect, 220. Sales commission and admin, period expenses, so they go straight to the expense accounts. Okay, sales expense, period. 86, this was for the utilities, okay, the utilities for the factory, so we charge it to manufacturing overhead. Advertising expense is a period cost, so it goes directly to the advertising expense account. Depreciation, 560 related to the factory, so we had charged that to manufacturing overhead. 140 was for selling and admin, so we can take it in the current period to depreciation expense. Insurance, 14 related to the factory, 6,000 related to selling and admin. And then this was our application of our predetermined overhead. So 960 as a debit to work in process, and 960 as a credit to manufacturing overhead. This was the transfer. We finished the goods that were in production and we moved them into finished goods. So we reduce work in process inventory and we increase finished goods inventory. Then we record the sale of 3 million. And the last part is to transfer the goods from finished goods inventory because they're no longer available for sale, and we've moved them over to cost of goods sold. Okay. T accounts I want to show you guys. So here's the T accounts. AR, simple, following along. Letters obviously match to the transactions noted above. What I really wanted to focus was on the manufacturing overhead here. Okay. So manufacturing overhead, these are all the charges, okay? So the indirect material, the indirect labor, the utility cost, the depreciation, the insurance, okay? So these are the actuals on the left, on the debit side. These are our actuals. And then on the right, on our credit side, was, our application based on the rate that we determined. We end up with a $40,000 credit balance. What this means is we actually applied too much. So we applied $960,000 for manufacturing overhead, but we actually came in at $920,000. So we have a $40,000 credit balance that we need to eliminate because this needs to be closed out to zero. And we do that by debiting our manufacturing overhead account, and the credit will go to cost of goods sold, because buried in this 1.74 million is $40,000 of over applied overhead. And what we're saying is that we've overstated then our cost of goods sold, so we get to reduce it by 40,000, which will obviously help our position and give us a higher gross profit. And I will show you the income statement to show you what that looks like here. So the question also asked you to create the income statement. So sales, straightforward, they gave us at 3 million. So our cost of goods sold, which we thought was the 1.74 as given in K, we reduce it by the $40,000 that we have to adjust out of our manufacturing overhead account to 1.7. So our gross profit actually ends up being 1.3 million. And then we list, okay, standard expenses. We list them all. They relate to the items noted above. And our net operating income becomes $180,000. And then the journal entry again for the to close out the balance in manufacturing overhead account is the debit to manufacturing overhead and a credit to cost of goods sold. So this is just a great simplified example of how to track and record your costs when you're using the job order costing system. It's like I said, the more practice you do, the more this will make more sense. If it's the first time that you're looking at it, it probably will be overwhelming, but you will have extra materials that I'm going to give you to practice between now and your midterm and quiz, etc. So what is really important that I would say is that you really understand a couple of things here. Number one is how to determine your predetermined overhead rate is first and foremost. Second, make sure you clearly understand the movement of inventory amongst the different accounts, okay? That raw materials, work in process, and finished goods are all inventory accounts, and that the purpose of recording all of these transactions are to move the cost through the various different buckets, with the ultimate ending being when we get to cost of goods sold once the goods have been sold. So understand that, okay, that we're watching the costs move throughout the production and ultimately to sale. And then lastly, the impact on our manufacturing overhead account. Okay, that on the debit side, we're recording the actual costs. On the credit side, we're recording our estimate budget based on what we thought at the beginning our budgeted costs were going to be, what our budgeted input hours were going to be, or whatever our base is. And that we then have to clear out the balance. Okay, if we forget and just leave the balance at 40,000, then we will have overstated our cost of goods sold, which understates our gross profit, which understates our operating income. And we don't want that to happen, because then a job that actually was more profitable could look less profitable, and then you're going to make poor production or sales decisions based on information that's wrong. So that is a really critical component that we understand, that you have to make that move to close out that manufacturing inventory, manufacturing overhead account once all the job costs have been entered. Okay, so this was my my extra on job order costing. You have 2 other videos that I've posted. I posted a document about the advantages and disadvantages of job order costing, and I think I've got a couple of more diagrams that I want to post for you guys, just to show you the flow of data, and just to basically summarize the main overhead, the main concepts that you have to understand when we're talking about applying overhead. So I would suggest that you take a look at this question on your own. Don't worry about, look at the solutions afterwards, but try to go through the exercises, the journal entries yourself, so that you have a clear understanding. And I'm going to post something very similar for you guys to work on as well. So that is that. Thank you very much, and good luck, everybody.